For centuries, money was something you could physically hold. But today, value moves entirely differently, as code, zipping across a borderless digital landscape. Over the last decade, traditional finance has found itself facing a global challenger: private cryptocurrencies and dollar-pegged stablecoins. These private digital assets arrived with a compelling pitch. They offered instant, round-the-clock transfer speeds, low fees, and smart contracts that could be programmed to execute automatically. But allowing private tech companies to control the foundational layer of money presents a severe risk. If a nation loses control of its currency flows, it loses its monetary sovereignty, putting the entire financial system at risk. Now, global regulators, led by the Reserve Bank of India, are pushing back against the reliance on privately issued digital assets. Instead of stepping aside, central banks have engineered their own counter-technology, the Central Bank Digital Currency, or CBDC. A CBDC is simply a digital form of sovereign legal tender, designed to be exchangeable on a strict one-to-one basis with physical paper currency. It gives users the same technological upgrades that stablecoins boast: efficiency, speed, and programmability, but removes the risks of a privately managed asset. Central banks are co-opting the blockchain-style tech of their competitors. By adopting the very tools private tokens use, they can neutralize the threat and maintain control over the financial system. To see why governments are so defensive, we have to look at how these tokens are created. Private stablecoins are issued by corporations, while sovereign money is backed by the economic output of an entire nation. In economics, there is a concept called the ultimate settlement asset. Central banks mandate that their money holds this position, meaning a transaction settled in sovereign currency is final and legally indisputable. Private stablecoins, by contrast, lack that deep sovereign backing. Their value relies entirely on corporate reserves and market sentiment, making them a fragile foundation for any large-scale economy. When a crisis hits, markets panic. In those moments, only government-backed money provides the absolute anchor of trust required to prevent a systemic financial collapse. The Reserve Bank of India has already moved from theoretical white papers into deploying live code. Starting in late 2022, the RBI launched a retail CBDC pilot program to test the technology in real-world scenarios. The adoption metrics have grown quickly. Currently, over 8 million distinct individuals are actively using the digital rupee. This chart shows the scale of that pilot over time. Transaction volume has surged, recently crossing the 120 million mark since the program began. Proving the technology works on a domestic scale is crucial, but these local results are the start of a larger global strategy. The primary target of the CBDC initiative is to solve the inefficiencies of cross-border transactions. This global map shows the scale of the issue for a nation like India. It is a leading recipient of inward remittances, with a record-high $132 billion flowing in last financial year, primarily from the US, UAE, and the UK. And the trend is continuing. So far in the 2025 to 2026 financial year, Indians living abroad have already sent over $107 billion back home. Currently, every dollar in that system is slowed by the friction of international banking. Multiple checks at various institutional levels make transfers slow and costly. For nations heavily reliant on these inflows, eliminating this friction is an urgent macroeconomic priority. But the RBI has identified a systemic catch. A domestic CBDC is only useful for cross-border payments if other countries adopt the same technology simultaneously. This requires coordination between global central banks and international monetary bodies to make the system interoperable. That diplomatic push is actively underway. The RBI is currently in direct talks with central banks in 4 to 5 advanced economies across Asia and Europe. The goal of these negotiations is to collaboratively engineer new, unified cross-border transaction rails for both wholesale and retail money movements. The future of international money transfer likely won't be dictated by a private tech company. Instead, it will be driven by a highly coordinated, ultra-fast network of sovereign digital currencies.